A survey will be sent out at the end of the week for your feedback. It is very important that you guys fill out that survey for us. That lets our funders know that our programming is making a difference. We will email you links to the recording and the material, so you'll get all of that information. Please mute yourselves during the presentation and use the hand raise tool or the chat if you have a question. And during the Q&A, we will make sure that we answer all chat questions first. And with that, I'm going to pass it over to Melissa Glenn, who is the Chief Operating Officer at Nebraska Enterprise Fund.
Thanks, Deanna. I really appreciate it. Very excited to be here today. I see a lot of very familiar faces and a lot of new names, so I'm excited to hopefully meet with each one of you. So what I would like to do with this presentation as I get this loaded here is I'm going to go through some high-level information, which I'm assuming that a lot of people on this call are already familiar with. And then I'm going to go into a little more detail into some of the content, but I'd also like to leave a lot of time at the end for Q&A because as we've all know, when we go into a loan application process, there are so many differences in the type of loan that you're applying for, in what's required, what the underwriter is looking for. So I'm hoping that I can leave time for all of that if we have anything specific. First off, could I get just a thumbs up? Is everyone able to see my screen okay? We're good? Okay, perfect. Excellent. Thank you. All right, so we'll start off. Just a little bit of background of what we are. What is Nebraska Enterprise Fund? We are CDFI, so that is a community development financial institution. So again, that's exactly how it sounds. We promote community development. There are a lot of times where a bank will have a very, very specific credit box that they are able to look at. And if all of the parameters of that loan don't fit within that credit box, they typically can't go forward. That's where we can come in and we can figure out how can we try to make the request work? How can we make the business stronger? And the ultimate goal is strengthening the community, one business at a time, one education session at a time, and one person at a time. So again, we are a legal non-government entity, and we serve and maintain accountability to our target markets. So what does that mean? Our target market, again, small and micro business. That means 10 employees or fewer typically. There are 31.6 million micro businesses, and that makes up about 44% of America's GDP. These are not small numbers. It might be small business, but it is not small numbers. So this is a massive piece of our economy. And when we're looking at loan products, again, this is what Nebraska Enterprise Fund offers. You'll look at other CDFIs, other banks. There are going to be some other loan products that are offered, but the underwriting of the process is a little bit similar. So that's what I'll talk about here. But again, what we look at is cash flow. So can the business make money? Is it viable? Is there a strong marketing plan? Does this business have potential? If it's not quite ready, what can we do to get the business ready? So if you're not quite fully bankable yet, so maybe there's a credit score issue, some, life happens. Sometimes it doesn't happen at the time we'd like it to. How can we go overcome those things and move forward with the business plan? So again, we can look at direct lending. That's anywhere from 1,000 all the way up to 150,000. That comes out of our direct loan fund. We can work with a bank if we're looking at gap financing. So maybe we have a bank that says, hey, I'll come in for part of it. Can't do all of it, but I'll do some. Talk to us. We can figure out what that might look like. We can take a second or subordinate position. I can get into that in terms of collateral. And then looking at invoice financing. So, a lot of times, especially in a construction environment, you have to wait 90 to 120 days in order to receive payment. That's not always viable, not always feasible. So we can come help and help that shortfall there. And then we're also looking at, how can we build credit? We have a rapid loan. Let's say you just need a new computer or something that's a quick fix. We can help with that as well. Also emergency loans. We've had a couple of instances of those. Unfortunately this year, those things happen, but we were able to step in and make sure that business, So what else can we do? So if we have a request that is above 150,000 and we go beyond our direct loan fund, there's something called the SSBCI. So that's the State Small Business Credit Initiative. So again, that's run by the US Treasury. They have allocated funds to the state of Nebraska that we could come in and say, say you have a loan request with your bank. Your bank can go up to, just for an example, it's $300,000 total. they can do 150, we can come in and do a 150. We just closed on one that was over 3 million. So these are, again, not small numbers, but we have seen several business owners who have started with us. They've taken out a small loan. They grew their business from the ground up, and now they're ready to expand, buy a new building, purchase a different business, whatever the case may be. And we're able to come in and work with a bank in order to make that happen. Okay, so criteria, why are we here? A lot of times the expectations of a loan on the outset look pretty simple, but they get really detailed as we go into it. So I'll get into what that means. But overall, what we're looking to do is to say, do you have a strong business plan? What are your financial projections? Do you have a strong marketing case? What research has been done? Where can we come in with some additional work there if needed? And is there, a plan of growth for this business? So typically, we'd look at, credit scores of 600 or above. Really depends on the circumstances there, but just in general, we would love to see if there's any sort of personal investment, so 10 to 20% coming into the business. And then collateral, again, we have some flexibility. So I'll just talk about a little more details of, kind of what all of this is. But just again to reiterate, there are a lot of community services that are available. So again, through Nebraska Enterprise Fund, we've been around for 30 years. This is our 30th year. We offer microloans. There is a revolving loan fund. There are a lot of different aspects that you can look at where we can finance some deals that, a bank may not be able to finance directly. So, would you lend me money? That is the big question here. If someone came to you and said, "Hey, I need to borrow $100,000 or whatever it is," what is the criteria that you would look at? So typically what we would say is, well, you need to know information about me, the borrower. What is Melissa's financial credibility? What type of business is she going to be operating? What's her competitor look like? Are there a lot? Are there many? Are there few? Is it strong? What are her suppliers? Who are going to be her customers? What's the industry? What's the trend? So how do we break all of that down? So this is how a banker would do that. There are 6 C's of credit, and I'll break down each one of these, but we're looking at character, capacity, cash flow, collateral, capital, and conditions. And generally, this is the order of importance of what we would look at the loan as well. So when we're looking at this character, again, the biggest thing is there a willingness to pay that back? So, just for an example, if we see a history of someone who's taking out a loan, then maybe make one payment and then make no payments after that, and there isn't anything that would explain the situation, that's a big issue. But on the other hand, if we see someone who would come in and say, hey, took out a loan, made a few payments, ended up in the hospital, or COVID hit or whatever, and then they figure it out a way to restructure the loan in order to continue paying or keep this viable. Those are 2 very different scenarios. So we would look at that as what is the willingness to pay, and then looking at the credit history. I think there's a lot of question on what exactly is the credit report that's pulled, and I think it's really important to pay attention to not only your credit report, so you can go into Expedia or Credit Karma or whatever, that gives you a good guideline, but it's not the official credit report. So we oftentimes will see differences between, those services and then the official credit report itself. So I highly recommend at least once a year, go to annual credit report or freecreditreport.com and make sure you pull your official credit report and fix any issues that you have on there. Capacity. So again, your experience. If I walked into a bank tomorrow and said, "Hey, I would like to, I don't know, buy a concrete truck, so that I could start up a concrete business," they'd look at me a little bit funny and say, "Well, what experience do you have?" And I'd say none. That might be a little bit of an issue. But if I said, "Here are the classes that I've taken," or "Here's the hands-on experience that I've had," or "Here's the partner who's coming in with all of the experience, so they're going to do the work and I'm going to run the business," that might be something a little bit different. But you have to look at what is your capacity to understand this business in order to run it well, and what are the income and expenses? What are your projections? So are they rational? Are they reasonable? If you come in and say, "Hey, I started this business on my own. On the side, I made $4,000 last year. It's just a little side income. But I expect next year I'm probably going to make $1 million when I go full time." I hope you do. I sincerely hope you do. But is that rational? Is that reasonable to say that you're going to have $1 million increase from one year to the next? Again, not to say it couldn't happen. Most of the time, though, we have to figure out what's rational, because the last thing that we want to do, or that a banker wants to do, is say, "Hey, no problem. Here's this money, and if the business isn't viable, you're going to be the one who suffers. When you can't pay this back." So we need to make sure that everything makes sense. And then cash flow. So money in and money out. How much money is coming into the business? How much is going out, and what's left over? So you might have a lot of sales, but if your sales, if you're selling something that's expensive, or maybe you don't have the right supplier, or expenses are out of whack, or you're paying too much for a storefront, or whatever it is, you're making a lot of sales, but you're not keeping a lot of that money in the business, we have an issue. So that's out of balance. We need to figure out how can we improve that cash flow. So again, we're looking at accounts receivable, your accounts payable. Is there any stale inventory? Have you paid for something that you just can't sell? Do you need a line of credit? What makes the most sense here? But the biggest thing again is just how can we make sure that the cash flow is going in the right direction. And collateral. So this is where, we kind of differ, and bank to bank will differ in terms of what they're looking at or what they need. So, in terms of what is the repayment source, a lot of times you'd say, well, I'd have equipment, for example, or I'd have a home, or whatever it is, or maybe it's just accounts receivable. If it's service-based business and there isn't any inventory, we'd need to look at that and take a whole look at the loan itself. How much is each collateral piece worth? And then what is the repayment value of that collateral? So, used piece of equipment, for example, we might not even be able to go up to 50, maybe 60% of that value to go toward the collateral value. If it's brand new equipment, you could usually say 75, 85%. If it's accounts receivable, it just really depends on the type of business. Will they pay it back? Is there a strong repayment in this industry? What is the reliable way where if something happens, we could take this collateral and pay off the loan, so that we're free and clear on the debt. But again, this is just varies from banker to banker. What we look at though is what are the different avenues to here. So if it's not equipment or some sort of physical asset, who are the guarantors? Is there another co-signer? Is there some other cushion that exists that would help the business in case something happened for the primary source of the income from this loan? And then also looking at the SBA. So the Small Business Administration, they could come in and the government would not pay for the loan. They wouldn't pay your loan off, but what they would do is guarantee the bank for up to 75% of this loan. So the bank would feel a little bit more comfortable, knowing that if something happened, they would get at least 75% of that loan paid back. But that's only for the bank. The borrower is still is on the hook, but is still responsible for the full amount of the loan. So that's just something to keep in mind as you're looking at all of the different lending options. And then capital. So that's money in. Have you saved money to put in for a down payment? That's not always a straight cash injection. That might be money that you've already paid toward the business. That might be some equipment that you've already paid that you would have taken a loan out for. Not every bank will look at it that way. Some will. And just what is a risk of this business, and how much would theoretically need to be put down in order to make this loan work. So for right now, trucking, for example, has been an industry that has been hit pretty hard. Hopefully it'll come back. But I think right now, that's again just an example. That might be one where a bank would say, we can do the loan, but we're going to need X number of percentage cash equity into this, and we'll cover the rest. And then conditions. So this is again another catch-all. So there are some standard conditions that you'll see in pretty much every loan, which most of those says at least yearly, you need to send the bank your financials so that they can make sure that everything is on track. There's always the condition that says, hey, if we missed something, you need to go back and sign these loan documents. That's all pretty standard. But there could be other things. So there could be different loan covenants that says, We need to, do site visits. We need, and that's usually pretty standard too, along with the financials. But there could be others that are just a little more involved. So maybe instead of annual financials, it's quarterly. So maybe you're a brand new business, or maybe it's a business that's a little more risky. The bank could say, that's fine, we'll do the loan, but we're going to make sure we have a really strong relationship and work with you along the way, just to make sure that everything is on track. So how do you get a loan? First and foremost, like I said earlier, know yourself. What are the things that you're really good at? And that doesn't necessarily mean a skill. It could just be, how do you operate? If you are excellent at, aesthetics, or you're a beautician, you do hair, that's your thing. Awesome. Make sure you have a business mind who can support you, or you surround yourself with your own personal board of directors, to know that there's nothing that's going to fall through the cracks. So you don't have to be good at everything, but you really need to know yourself to know what you're good at, and where you're going to need to employ some additional help. Yeah, there's training, there's assistance, but does the business fit? So again, if I woke up tomorrow and said, hey, I'm going to start a concrete business, I might need to think twice about that and talk to people who are already in it to see, is this viable or is it not? And then make sure I do a lot of research on the back end. And then know your business. You are going to live and breathe this business day in and day out. So make sure it's something that you have at least a basic level of enjoyment on. Making money is important, but if you just end up absolutely hating what you do day to day, that money isn't so fun to make anymore. So make sure that you know that it's something that you can do day in and day out, even when those days mean, 12 hours a day, 16 hours a day. You wake up, you're in your business. You go to sleep, you're thinking about the business. I'm sure there are some entrepreneurs in this group that can attest. It's not a 9 to 5 job. So make sure that you can go in every single day and know it and love it, and know the good, the bad, and the ugly. I have seen several instances where, we have some really great people who are well intentioned, but they've only focused on the pieces of the business that they've liked, and they've ignored the pieces of the business that are a little tougher to swallow, not so great to look at. Maybe the numbers are struggling, maybe the supplier is going out of business, maybe your biggest client, has either shut down or moved or whatever happened. It's extremely important to tackle those things early, and then they won't exacerbate and make the problem even worse later on. So again, building your team. We don't expect that anybody should come into business and be an expert in all four of these areas. That really doesn't typically happen. And I'd say, if you think you're an expert in all of these areas, double check with someone who makes this their primary focus day in and day out, to make sure that you have the latest information and to make sure you aren't missing anything. Because there's always, always going to be some piece of advice that will help you and help your business. So make sure you have your accountant, your banker, your lawyer, and your insurance person. If you go the opposite way, it's your bail team. Just make sure that you have the people in your corner who can help you out throughout good times and struggling times throughout your business life. And then again, just going back here, really, really, really know your personal credit status. Again, we pull the official credit report, which has a lot more detail than what you'd see in, like at a Credit Karma or Experian. So make sure that you know this inside and out. So maybe there, was a hospital stay, or something where there was a few $100s left over that you didn't know about. It's going to show up on this credit report. So make sure that you are doing your homework. And then if there is some sort of explanation letter, send that over, and then make sure you're addressing any issues directly with the credit bureaus, to make sure that you can fix all of these things ahead of time, ideally before you apply for the loan and before your bank will pull that credit report. And then, excuse me, equally important, we need to make sure that you know your personal finances. So a personal budget is great. That's what we're going to need. But when we go in, especially looking at an SBA form, you're going to be filling out a personal financial statement. So that is How much money are you paying for a rent or a mortgage? How much does your car cost? How much are you paying for food, utilities, medical, pets, kids, whatever it is? Every single penny that you spend every month needs to be accounted for, because the banker is going to look at this from a global perspective and say, okay, we know that the business can make money. We know that this is viable, but does the borrower have all of their finances in order as well? So if the business is doing well, but personal finances are really, really struggling, there's always the draw that says, well, they could potentially take more from the business than they should in order to cover personal expenses. Then the business will suffer, and then eventually everything falls. And that's not what we want. So we need to make sure that, both sides of that equation equal out. So that, again, ultimately, you are in the best position that you can possibly be when you're owning and running your business. And then again, know your experience. Just be very, very, very honest with yourself on, do you need more leadership training? How many management roles have you held? What technicals training do you need? Is there something like SCORE, for example, or NBDC, or even talk to NEF or any of the many, many organizations within the community that says, hey, I need to polish up something. You're already doing this, attending this lunch and learn through Spark. So get as much information as you possibly can, to make sure that your experience is as strong as possible. And again, anyone who's started a business or held any sort of a high level management role within a business knows that you could be perfectly prepared and something will come completely out of left field. You weren't expecting it, and you'll have to deal with it. So the more experience you can have, the better you're going to be able to position yourselves when those things happen. And then the business plan. So again, address each of those 6 C's of credit. Put that right in your business plan. How have you shown that you've done your research and, looked at every possible piece of the business that you need to? This one is huge. The use of the loan proceeds. Make sure that this is as detailed as you can possibly get it, and make sure that you have had someone else look at this with you. So let's just say, just as an example, you wanted to borrow $100,000. And if you walked in and said, hey, Melissa, I want to use maybe 10,000 of it on equipment. We'll use another 15 to 20,000, we'll say 20,000 on working capital, buying some other equipment or, buying staplers or whatever it is. And then I think the other 50,000 is going to be used for a car. And I'll say, wait a minute, hold on. Maybe that's not quite the balance that it needs to be. Do you really need to spend $50,000 on a car when you're only spending $10,000 on equipment? And let's just say it's a cleaning company. So I'm just making up some wild numbers here, but does that make sense? Is it prudent? Is it sufficient? In this example, for a cleaning company, I'd say no. You don't need a $50,000 car and only $10,000 of equipment if you're going to be starting a cleaning company. So let's walk through this and see what is it that you actually need. How is it all going to be allocated? And then again, make sure that it's prudent and sufficient. So sufficient, again, on the other side is don't go too low. I've seen some high numbers and I've seen some really, really low numbers. And what happens if you borrow too little? Well, that means that you won't be able to get your business established as well as you could have otherwise. And then that means that the business will either grow slower than it could have, or worst case scenario, that business is going to fail because there wasn't enough. So make sure again that you find that right balance. Don't borrow too much, don't borrow too little, and make sure that you're really, really careful on how you are writing out those use of loan proceeds. And again, projections. I just can't stress this enough. Make sure that this makes sense. So if I said, I'll go back to my cleaning business, let's say first year, I would expect to have, I don't know, $20,000 in revenue. Fine, that sounds good. But then you said, I'm only going to hire one more person, and I would expect that my revenue is going to go from 20,000 to 500,000 with one more person. Maybe prove it. How does that make sense? What is the additional input that that person is going to bring, how is that going to lead to additional income? And then how does that support the projections, and make sure, again, you're breaking everything down. So the business type, product type, service type, all of that, but also include expenses. If you're growing your business, theoretically, your expenses are going to grow right along with it. So make sure you don't ignore that piece of it as well. And then sources of owner's equity. So again, how are you going to be secure as the owner of the business as you're putting everything together? And then what is the backup plan? So, what if, and what if always happens at some point or another? What are you going to do to adjust within your business to make sure that this is still self-sufficient? And then business plan help is always available. I highly recommend working with someone as you're first starting your business plan, or even if you already have a business plan and you'd like to strengthen it, work with somebody. It's always good to get someone else's input and advice, and use your own gut check. You're the business owner here. So maybe that advice doesn't quite make sense, but you think it through and figure out why it doesn't make sense. Or there's something where, you can tweak what you're working on, and that might have some even bigger rewards down the road. So we're happy to help with that. There's SCORE, NBDC, all kinds of free, really solid opportunities within the community. And then what is the cost of a loan? So for example, let's say you take out a line of credit. Typically, how this is going to work is you will have 12 months, and you'll have a cap. So let's just say it's a $50,000 line of credit. You've got 12 months to spend that 50,000, and you could spend that money, you could make payments, you could go back and forth, but at 12 months, however much is still outstanding, so however much you've borrowed, will then turn into a term loan. But up until then, you're going to see some different terms. So sometimes you might have interest only throughout that 12 months. Sometimes you might not have any payments. Sometimes all of the principal is due upon maturity. And sometimes that maturity is maybe only 24 months. Maybe it's only another 12. Sometimes they could go up to 5 years. It really just depends. So read all of the fine print on anything that you're taking out. But then, again, remember, typically on a line of credit, you'll see a variable daily interest rate. So right now is prime plus, let's just say 3. So, I think prime right now is still at 8.5%. So, it's not cheap money when we're looking at this. So make sure it's spent wisely. And then again, term loans. So typically, a term loan, you'd be looking at anywhere from 3 to 5 years if it's just for equipment or working capital or something like that. If you're buying real estate or really large pieces of equipment, typically we can go higher on that. So 10 to 25 years if you're working through an SBA loan. So again, you're going to have set monthly payments, obviously includes principal and interest. It's tied to those fixed assets. And then again, just make sure you're keeping in mind, what does that actually mean? Especially the difference of a term loan versus a line of credit, or if you're taking out both, just make sure that that debt is sustainable. And then SBA. So I talked about this a little bit earlier. And again, if you go through Nebraska Enterprise Fund, we can do an SBA loan, or you could go through a traditional bank. They would have SBA products as well. So typically the SBA would look at this and not necessarily look quite as hard at capital or collateral, excuse me, as some others might. Again, same thing on capital. Some banks, if you're looking at a commercial loan, for example, they're going to require a minimum of 20% into this loan. So that's 20% of your own capital. The SBA would require 10%. If you're looking at a separate like direct loan product through NEF, it could potentially be lower. It really just depends on the project itself. But then they look at, what's the character, capacity, or cash flow. The SBA is really focused on the others, while the bank is looking at, again, the other C's of the credit. So make sure that you're securing enough sufficient working capital. So we talked about that a little bit earlier. Don't borrow too little in order to make sure that you're still set, for the first 6 or 8 months while you're building up your business. And then again, working through the SBA could sometimes be a little more appealing to the lender for reducing the lender's risk, not your risk, but the lender's risk. And then again, look at the term of your loan. Maybe 3 to 5 years isn't quite long enough. Maybe those monthly payments are going to be too much. Look at a different product. So if you reach a point where you maybe can get approval, but it still doesn't quite work as well for your comfort level, then look at an SBA product. They can do 7 to 10 years for equipment, or 15 to 25 years again for real estate. So sometimes that helps. And then there are some other, fee breaks and that kind of thing if you're looking at some smaller size loans. So again, every business starts from scratch and every business has the ability to succeed. It really just comes down to preparation and hard work and making sure that you are absorbing all of the information that you possibly can from people who are here to help. So every business can be a successful business. Right now, I'll open it up to any questions.
And you can either type your question in the chat box or you can use that hand raise tool at the bottom and I can call on anybody who has a question. Okay, well, while I let some people type, I know that we have some questions we would like you to answer, Melissa.
Sure.
What is the time frame for getting a loan?
Good question. Maybe it might sound a little bit like a politician here when I say it depends, but it really depends. But I would say on average, prepare for 4 to 6 weeks for the full underwriting process to take place. One thing that isn't in the PowerPoint, but I do think is really important, is to talk through what does an underwriter ask for, and what documents should you be prepared for. So the reason why it takes so long is because there is a massive amount of information that's needed, for the inputs for the underwriter to do their job. So typically 2 to 3 years tax returns, 2 to 3 and personal and business, 2 to 3 years of your personal financial statement. If the business is already started or something that you're purchasing, make sure that you've got 2 to 3 years of your P&L, your balance sheet. So make sure the financials are in order. We typically will need 3 months of bank statements for all accounts, personal and business, along with any equipment lists. We have to go through all of the projections and check everything. So I would say on average that 4 to 6 week time frame is pretty much average, as long as you have all of the information already prepared.
Thank you. Next question, does having a real estate loan with Spark Capital, would that help or hurt someone?
It really just depends. I wouldn't say it's a bad thing at all. Really, we look at the global cash flow. So if that real estate loan is extremely expensive and it doesn't leave you with a whole lot of cash left over at the end of every month, that's ultimately going to hurt you, because that, just condenses how much you're able to handle in terms of the total debt limit. But real estate is an asset. So as long as those payments are manageable, even better if those payments are low, you are financing something that you're building equity in, and you can in turn use that as collateral to help support another loan. So again, it just depends, but I wouldn't necessarily say it's a bad thing.
Very good. Someone asked, what happens if you borrow too much money and don't end up using all of it?
Yeah. Oh, really good question. I'd say go back to your bank and talk about what that looks like. So, one, the most simple thing that you can do is try to find some sort of savings account that has, right now it's tough, but has enough of a return to make it worth it, so that you're not losing money every month, and you can always just keep it there as a cushion. There could potentially be, if there is another piece of equipment that you said, hey, maybe in 6 months, if I got this piece of equipment, it would help the business grow even more. Maybe you push that time frame up just a little bit. Or if you just straight up said, hey, this is a really good thing, I borrowed too much, go back to the bank and see if you can refinance the loan down to a smaller amount. I don't think any bank is going to balk at that if it makes your cash flow position even stronger.
Very good. Someone asked, what are the names of places to get help with business plans?
Ooh, yeah, there are a lot. So, Nebraska Enterprise Fund is one. SCORE, Nebraska Business Development Center, Grow Nebraska Business Development Center, NBDC, which is the Nebraska Business, the Nebraska Business Center. I know I'm blanking on a few more, but we actually have a resource on our website that should be updated, but it has all of the community partners that we're working with as well. There are many, and there are some too. It really just depends on what you're looking for in terms of your business plan. Most are free, and I'd say most of the time, those free options are enough as long as you can dig in and get all of your questions answered. There are some folks that will provide the service for a fee. So if it's affordable, and if it's something where you still fully understand the process, those things are available as well. But I highly recommend starting with any free option, and then working with your banker and go from there, because the banker is happy to give any review of that business plan as well.
Very good. Someone asked, who decides if we get approval and who is on the loan committee?
Yeah, good question. So the approval really starts with the preparation of all of that documentation and going through the underwriting process. So the underwriting process is there again to see, is this viable, and can we get a full picture of what is this business going to look like? And we do that by dissecting all of the numbers. So, again, do the numbers that you have presented for either the supply costs and the expenses and the revenue outlook, does that make sense for different industry reports that we would pull? If they are different, why are they different? How can we delineate that? And then coming up with all of the ratios that an underwriter would look at. But basically, the big one that we'd look at is a debt service coverage ratio. So if you have enough money coming in order to have some money left over after all of the expenses are paid, that's essentially what that ratio is looking at. That's a really big indicator. So without getting into the nitty gritty of all of the underwriting process, that's essentially what they're looking for. And then in terms of the credit committee, um, that's never really released because we want the credit committee to just look at the numbers. We don't want any outside influence on here. We just present the numbers as they are. And if something doesn't make sense, the credit committee typically is made up of either underwriters or bankers, or other business owners who've been there and done that, know what to look for and know what some of the green flags are and what some of the red flags are. Um, so without giving a completely black and white answer of, if you do three things, there's a loan approval. Just know that any business, who is applying for a loan, know that the person who is reviewing this loan is trying to get to a yes. And how can we make sure that if we have to say no, how can we strengthen this business so that we can get to a yes next time?
Next question, is Nebraska Enterprise Fund only available to Nebraska businesses?
Good question. No, we're actually in Southeast Iowa as well. So all of Nebraska plus Potawatomi County, and then the surrounding, I believe it's 6 counties that surround Potawatomi County. Great question.
Someone asked, how does this interact with real estate lending in regards to passive investments, development, construction of homes, rental
Yeah,
property acquisition, etc. with SBA? And is there
great.
any issues with stacking any other funding types?
Great question. So, real estate is a lot more complicated when it comes to passive real estate. So, one thing that, like for Nebraska Enterprise Fund and the SBA have said is that they won't finance passive real estate, because the ownership, tends not to create additional jobs. Now, there are some arguments that says, well, we're employing contractors, you're rehabbing a home or you're employing property management or something like that. And that's all very true. But we'll take the same stance that basically says if the SBA won't finance that, it's typically not something that we can finance. But there are banks that specialize in that. And typically you'll find either banks or some other CDFIs too, that will do some types of real estate, typically not passive. Typically, that's going to go through a traditional bank. But there are some very, very good bankers that specialize in real estate transactions in town. And I honestly, I won't name any because there are quite a few, but if you wanted to send me an email, I'm happy to send some warm introductions to some bankers that look at this. But essentially what they do, again, if they can finance passive real estate investments, they'll look at it similarly as what we would and say from a global perspective, what makes sense. So, how many houses are in your portfolio? What's the average rent? What's the condition of the home? What does maintenance look like? What do, all of the factors that go into this? They'll still take a global look at this, and then take a look at, your personal finances and business finances, just like any other business loan would. That's a great question.
Next question, how do you find the right bank to help you reach your personal goals?
Ask a lot of questions. If you meet with one banker, don't stop there. Meet with several bankers, ask them what they look for. It's okay to ask, what does this bank specialize in? There are some banks that will specialize in passive real estate investments. There are some that won't touch it. There are some that will specialize in healthcare. There are some that will do more small business SBA loans, and some that will stick to larger commercial real estate deals. It really just depends. So I think, finding the right bank is kind of like dating. You just have to ask a lot of questions and, talk to a lot of people and just make sure that the fit is okay. And, I used to work at a bank too. If the fit isn't there, that's okay. I'll still support you and try to make referrals and, send you to some place that can help you, even if my bank can't. And that's what you should look for, I think, in a lender as well.
This person asked, if I have a written out business and financial plan that NBCD helped me with, what will my next steps be in terms of business funding?
Ooh, good question. I would say at that point, if you are ready to take on financing, I would start talking to your banker right then. The banker is then going to take a hard look at that business plan. They'll give you some feedback. What they're really going to do, though, is start diving into your projections to say, does this make sense? Did we miss something? Are there some expenses that are either too high or too low? And can we rebalance those? But I'd say once you have everything started and you yourself know those numbers inside and out and you feel comfortable with them, pick up the phone, start talking to the bank, and if you're prepared, there's no reason to wait.
This person asked, is Nebraska Enterprise Fund Loan in business name or the owner's name?
Business name, good question. There is a personal guarantee though. So if we take out a business, let's say I take out a loan in the name of Melissa Glenn LLC, Melissa Glenn, the individual, is still a 100% guarantor on that loan. Even though I'm not the loan isn't in my personal name, I still personally guarantee the loan.
What is the age requirement for a business loan?
Good question. Well, it really goes by the statutes of each state. So in Nebraska, the age majority is 19. So you need to be at least that old in order to take out a loan.
And one more question, I believe. If our LLC is a startup with no financial history, does our personal history have to cover that measure of loanability?
Good question. Sort of. And that is the big question for startups. So, one thing that I see a lot in someone who's starting up a business is you can't just quit your job. Typically, you can't just quit your job, start your business the next day, and immediately have funding in order to pay for everything that you need to live. So there's a balance there. So what I always recommend is that when you get started, and we have to have several things that come into play. So I'll just say we have a business plan, we have our financials, we know that this is solid, and we know that this is a business that can make money. The next step you have to decide on is, what is your comfort level to make sure that you can still pay your rent and keep the business afloat, and pay for food and all the things that you need to live. Can you do that from the business income, and at what point do you not need any other income to support yourself? So the answer is, you don't necessarily need to say, I can support all of the expenses of my business from my personal income, because theoretically the business should be making money. So the business should be bringing in money to cover those expenses. Um, but at what point does that table tend to turn, or does this equation kind of shift where it says it makes financial sense for you to focus 100% on your business? That's going to vary greatly. But what I would say is just be as conservative as you possibly can be, so that if the business isn't bringing in enough money or as much money as you thought it might, you have enough personal cushion to come in and cover it until that business is sustainable.
Very good. Our next question, is there a personal guarantee? Is loan reported on personal credit? I'm wondering if the loan will affect personal DTI.
Yeah, good question. So yes, there is a personal guarantee on any loan that's taken out. It shouldn't show up on your personal credit report because the loan itself is reported under the business. But if we're looking at DTI, that still is and DTI is the debt to income ratio. So if we're looking at this from a global perspective, which pretty much every small business owner is going to need to look at this. It still is going to impact you. So let's just say, for example, you have I'm just going to make up some big numbers. Just let's just say we have $1 million loan under your business. You owe $500,000 on a house, and you owe $70,000 on a vehicle. And let's just say the debt to income ratio is just teetering on the edge of what makes sense or what doesn't. And then you want to go buy an RV, for example. The RV dealer is probably going to take a look at this and say, hey, there's too much. There's too much risk here, because if one little thing falls in this, in this deck, then you're not going to pay me back. So the answer is sort of yes. But I think just make sure that you're looking at everything from a very strict and somewhat conservative lens that says, it doesn't necessarily mean that you can't take out additional loans. You can, but everything has to make sense as a whole.
Very good. I think I got all the questions in the chat box. So if you have any last minute questions, I think this is your time. Go through the participants. Okay, well, thank you all so much for joining us today. In the chat box, I did put our survey for this deep dive. If you could all please make sure you fill that out so we can let our funders know that this programming works, we would appreciate it. And if you have any follow-up questions or comments, Melissa has her contact information, and I will also send that through email as well. And you can always contact me if you have questions at Spark. Thank you, Melissa, for being here, and thank you so much, everyone, for joining us.
Thanks, Deanna.
Have a great day, everyone. Bye.